Hello and welcome to the third quarter DoubleLine fixed income asset allocation funds review. I'm Sam Nussbaum and I'm joined by my colleague Corey Claremont.
Hey Sam.
Welcome, Corey. Corey and I are both product specialists focused on our asset allocation products, and today we're going to talk about third quarter performance across three of our mutual funds, our positioning, and our outlook going forward into the fourth quarter of 2023. So with that, Corey, can you kick us off and talk about our DoubleLine low duration bond fund?
Yeah, of course. Thanks, Sam. So the DoubleLine low duration bond fund, it did have a really strong quarter. Net of fees on the institutional share class, it returned 131 basis points, and that's, again, over the third quarter. Relative to its benchmark, the 1 to 3 year Treasury index, it did outperform that return, which was 73 basis points. And then looking at the 1 to 3 year aggregate index, that had a return of 74 basis points over the quarter. So it was able to outperform both of those indices. And there was two primary reasons for that. First and foremost was our asset allocation. So when looking at the portfolio, we do have a large allocation to non-traditional fixed income sectors. Think of things outside of treasuries, agency mortgage-backed securities, and investment-grade corporate bonds. When looking at the 1 to 3 year investment-grade corporate bond index, that had a return of 75 basis points over the quarter, which isn't bad, roughly right in line with those two indices. But looking at the credit that we own within this portfolio, each sleeve was able to outperform that 75 basis points. That asset allocation definitely benefited. From a duration positioning standpoint, that was also a relative benefit to the portfolio because we were underweight duration relative to our benchmark being the 1 to 3 year Treasury index. As of quarter end, that had a duration of right about 1.8 years, and our duration over the quarter averaged 1.2 years. So we were 0.6 years shorter than the benchmark, and Treasury yields rose throughout the quarter. And while it was more pronounced on the long end of the yield curve, we did see some movement in the front end of the yield curve. The 2 year was up 14 basis points quarter over quarter. So having that underweight in duration was a net positive. In terms of positioning, we didn't make any top-down asset allocation changes throughout the quarter. We still are finding a lot of opportunities on the front end of the yield curve, and as a reminder, the yield curve is still inverted, right? So you're getting paid to hang out there more than if you were to step out further onto the yield curve. We still have an overweight to securitized credit, and our duration remains underweight relative to our benchmark. But Sam, taking a step further out on the yield curve, can you talk to us about our intermediate core and intermediate core plus space with the core fixed income fund and how that did over the third quarter?
Sure. So Corey, as you alluded to, the third quarter was certainly a rough quarter for aggregate fixed income or the traditional sectors of the market. So as you can see here on this slide, treasuries were down in the third quarter by 3.1%. Agency mortgage-backed securities were down 3.8%, and the aggregate index was down 3.2%. Thankfully, the core fixed income fund outperformed that index, its benchmark, by 30 basis points, rounding out its year-to-date performance just positive in positive territory, outperforming the benchmark by about 21 basis points. So in the third quarter, what drove that relative outperformance was certainly sector allocation. Given the fund's allocations to non-traditional sectors of the market, which tended to outperform, namely the biggest contributors to performance in the third quarter were collateralized loan obligations, bank loans, asset-backed securities, and high-yield corporate debt. So all those sectors have generally less duration, less interest rate sensitivity relative to the benchmark and relative to investment-grade corporate bonds. So those allocations all helped relative performance. And then duration was a neutral contributor. So duration of the fund roughly sits in line with its benchmark index at about 6.3 years as of quarter end. Allocations from the top down of the fund were stable quarter over quarter, so no changes made at any of our investment committee meetings in the third quarter. But going forward, also, as you alluded to within the low duration bond fund, we still continue to find a lot of attractive opportunities across various fixed income sectors. And we think pairing longer duration aspects of the fixed income market, namely treasuries and agency mortgage-backed securities, with a diversified mix of credit, gives investors today a pretty good opportunity set going forward. So with that, can you round us out in the non-traditional segment of the market with our flexible income fund?
Yeah, so our flexible income fund, it's in the multi-sector bond fund category. It had a great quarter of performance. It returned roughly 1.4%, bringing its year-to-date performance to 4.22%, and that is on our institutional share class net of fees. And there was really two main reasons that we were able to generate positive returns in a quarter where non-traditional fixed income struggled. And that was one, due to our asset allocation. So we do have a large portion of the portfolio in non-traditional fixed income. As you mentioned, they have less interest rate sensitivity, and you also tend to get compensated more for holding those in the form of yield. And so looking at the biggest contributors over the quarter, it was largely CLOs, asset-backed securities, and bank loans. And so 2 out of the 3 of those being floating rate in nature, right? Not really any sensitivity to moves within interest rates. And then secondarily, the income or the carry that we're getting on this portfolio is right around 9% as of quarter end, and that's our yield to maturity. So you're getting compensated to own these securities within this portfolio. So you put the two together and you get a return of right around 1.4% for the quarter. In terms of our duration positioning, on an absolute basis, it did hurt because we do have duration in the portfolio. It's right at about 1.8 years. Short end rates rose, so didn't detract too much from performance, but on a relative basis, especially versus some traditional fixed income vehicles like the aggregate index that has a duration of right around 6.3 years, it was a net positive, right? From a positioning standpoint, we did make one top-down sector asset allocation change, and that was in our August meeting. We decided to take 2.5% out of our emerging market debt sleeve and move that into our bank loan sleeve. We really view this as a tactical relative value trade. And the reason being is when you look at our emerging market debt sleeve, it has a duration of, call it high 5s, with a yield to maturity right around 9 and a credit quality, call it right around investment grade BBB rating. Within our bank loan sleeve, the duration is less than a quarter of a year. You have a very similar yield to maturity, call it about 9.5%, and you have very similar credit quality. So by making this move, we were able to kind of get away from that 5-year tenor of the treasury curve, reduce some of that duration within the credit side of the portfolio, while maintaining a similar yield to maturity profile and also a similar credit quality composition. And so looking at it, over the past month or so since we've made that move, it's worked out pretty well. September was a pretty rough month for the markets. Bank loans is actually one of the only positive performers. On an index level, it was up 90 basis points. And then if you look at emerging market debt, that was down about 2.6% on an index level. So only 1 month, but it's worked out so far, Sam.
Yeah, don't call it a trend. So if I could just sum up, the third quarter of 2023 is certainly a rough quarter for fixed income, particularly the traditional segments of the market tended to underperform. But going forward, the outlook for fixed income investors looks pretty attractive, given kind of the repricing of the yield curve, with rates certainly rising pretty much across all tenors of the curve in the third quarter. And that brings us to a more attractive point, really, than we started the year, which is almost hard to believe. With that, thank you for listening, and good luck going into the fourth quarter of 2023.